When I trade gold, I never touch a single gram of it. Not one bar, no coin, nothing in a vault with my name on it. And yet, I can make money or lose money on the price of gold by this very afternoon. Real money, without ever even owning a flake of the stuff. How, you ask? Because I'm not trading gold, my friends. I'm trading a derivative of gold. That word derivative is the single most important word in short-term trading. However, also the one nobody ever stops and explains. Traders and financiers alike say it, you nod because you don't want to look stupid, and you're never quite sure what it means, and you don't want to look silly for asking the question about knowing in the first place. By the end of the next few minutes, you'll understand exactly what it is, and you'll also never look at a trade in the same way again. Last episode, I drew the line, the distinction between trading and investing. Two different jobs that are commonly mistaken for the same thing. Today, the next question that'll be posed and answered in the series. When you place a trade, what are you actually really buying? Hi guys, and welcome back to Capital Clarity with Christian. 15 years across NAB and Westpac, and a full-time trader and financial fundamentals advocate, here to help you. Let's start by killing the jargon, by pulling the word apart. The word derivative, what it actually means is derived from. So what does that actually mean in a trading and financial setting? Well, it means the value of the thing that we're using is derived from something else. Nothing more to it than that. So in our case, a derivative is just a contract, and that contract is borrowed or derived from the price of the asset that we want to trade. That something else has a name. We call it the underlying. So when I trade gold, gold is the underlying. The contract I'm holding is the derivative. The contract will move up and down as the price of gold moves up and down. Think of it like a shadow. A shadow has no life of its own. It only moves because the object it copies moves. The derivative is the shadow. The underlying, the gold, the share, the barrel of oil, is the object casting the shadow. Hold on to that. Everything else today is just mere detail sitting on top of it. Now, the obvious question, why does any of this even exist in the first place? Why not just buy the actual thing? Well, let me tell you something. Derivatives weren't invented for traders. They were invented for users and producers of the assets that they represent. Think about that for a second. Picture a wheat farmer. It's spring. He's about to plant. He has no idea what wheat will be worth when he harvests in 6 months' time. If the price were to crash, he's absolutely ruined. Now, picture the baker across town that uses the wheat. He's got the opposite problem. He doesn't know what he'll have to pay for the crop or the flour come autumn. If the price spikes, he's also ruined. So the two of them do something very simple. They agree today on a price delivered at harvest. Done. Both of them can finally go to bed at night and not worry. That handshake is a contract. It's a derivative. In fact, the original one. We call it a futures contract. And the derivative is as plain as the story. A futures contract is an agreement to buy or sell a set amount of something at a set price on a set date. It was built to remove fear. It's a hedge, not to create a gamble. But here's the catch. Every contract needs two parties, two sides of the contract. The farmer and the baker locking in this price is called hedging. They are protecting themselves from a move that could hurt them. They're also the two counterparties in the contract. However, quite often, there's not always a farmer to complement a baker and a baker to complement a farmer. They're not always available at the same time, but somebody has to take the other side of every deal. And that somebody often has no wheat, field, or no bakery. No interest in the actual wheat at all. Just a view on where price is going in the future and has money to back it. That person is a speculator. They provide the much needed liquidity that allows the market the liquidity to flow. When you place a trade, you are the speculator. You are not hedging a wheat crop, you are taking a position on price. Remember that word, speculator. Later in this series, working out who is who, either hedging or speculating, becomes a really big part of our edge. So, out there in the real world as a retail trader here in Australia, you'll most likely meet three types of derivatives. Let me decode all three. The first one you already know, the futures contract, the user and producer contract, all growing up. These days it's standardized and traded on an exchange. Set sizes, set dates, everybody trading exactly the same contracts depending on the time. It's how the big players trade oil, gold, indices, and currencies. You're agreeing to a price today for a date in the future. Clean and transparent. The second is an option, and the word actually tells you what it is. An option is the right, but not the obligation, to buy or sell at a set price for a small fee. That fee is called a premium. Here's the way to feel it. Think of it like putting on a deposit for an off-the-plan property. Let's say an apartment. You pay the deposit today to lock in the right to buy at today's price. Once the development finishes, you can choose if you wish to settle or not. The market soars, brilliant. You've bought cheap. If the market goes down, you can just walk away, lose the deposit. That's your option. And the third is the one that most Australian retail traders actually use. It's called the CFD, a contract for difference. It sounds technical, but it's not. You and a broker simply agree to the difference between the price when you open and the price when you close. If it moves your way, the broker pays you the difference. If it moves against you, you pay the broker the difference. And this is the key thing to remember. You never own the underlying. No share, no gold, no barrel of oil. You are trading the price move and nothing else. CFDs trade over the counter, which it just means directly with a broker, not on a public exchange. The big question is, why have these CFDs exploded in popularity with everyday traders? 4 reasons. 1, access. From a single account, you can trade gold, oil, US 500 and FX currencies without owning or storing a single thing. 2, capital efficiency. A small amount of money can control a much larger position size. That's leverage, and it's the entire subject of the very next episode. 3, you can be long or short. So you can make money when the market falls, not just when it rises. And 4, low friction. You can be in and out in seconds. Every one of those is a genuine advantage in the marketplace. Every one of them is exactly why these things can be really dangerous in the wrong hands. So, before we finish, let me be straight with you like I always am on 2 things. First, scope. Each of these, futures, options, and CFDs, have real depth that I can't cover in a video of this size. Contract sizes, the expiry dates, the way each one is priced and financed, all things you need to go away and research yourself. Second, risk. Derivative is merely just a tool. It's neutral. It's the same honest contract the farmer used, but bolt leverage onto it and hand it to someone with no plan and no discipline and no idea, and it can cause some real damage. Now, I'm not speaking in theory about any of this. These are the numbers from our very own regulator, ASIC, the Australian Securities and Investments Commission. In 2024 financial year, that's 68% of retail traders in Australia lost money. Over 130,000 people lost more than $458 million. Gone. Only about a third of retail traders actually make money at all once fees are deducted on CFDs. Now hear me on this. The contract didn't ruin those people. The contract is merely just a tool. It was the leverage and the lack of plan that did most of the damage. And that is exactly what the next episode is all about. Quick note before we go on. None of this is personal financial advice. These are high-risk products. What I'm doing here is showing you how the machine works. Speak to a licensed professional before you get anywhere near any of these. So let's bring it home. You came into this thinking that trading gold meant owning gold. However, in trading, you're actually holding a contract, a derivative, whose value is borrowed from the price of gold, a shadow of the real thing. You're not buying the thing, you're buying the bet on the price change of the thing. Knowing that difference is important, or the difference will find you out. Now, here's one word I've deferred going into depth about: leverage. It's the most powerful force in trading and the fastest way to blow up an account. It's the reason most of those 130,000 people lost money. That is our focus for the very next episode. And honestly, you shouldn't even think of using any of these products until you thoroughly understand it. I hope you're enjoying learning with me. If you do, please like and subscribe to my channel. I'm Christian. This is Capital Clarity. We'll see you in the next one.